It's a good opening for the market. 50 points straight off the back on the index. The Sensex is up 160 points.
The entire up move that you're seeing today is being led by the consumer side of the market. It's a very marked and very decisive move.
What a stellar move today we are seeing on all the indices, actually. Nifty is up 105 points.
Been up 100 points from the word go, and we still got about 100 points to show for it. So there you go. It's almost as if, you could draw a straight line. Nothing has moved very much. We are going to end about 80, 90 points on top of the opening level from where you opened.
Hello and welcome to Markets Today, the show where we track about 6 hours of the day's trading action in 5 headlines. I'm Ekta Batra. Here are the top stories for this evening. Stock markets gain for the second day running. Sensex adds over 400 points. Nifty gains over 100 points. Midcap index hits a record high. SEBI bars Zee promoters Subhash Chandra and Puneet Goenka from holding any key position in listed entities. This poses another hurdle for the Zee-Sony merger, as Puneet Goenka was supposed to be at the helm of the combined entity. Zee promoters moved the Securities Appellate Tribunal against the order. MRF creates history, becomes the first Indian stock to hit 1 lakh rupee mark. It has taken the stock over 2 years to traverse the journey from 90,000 rupees to 1 lakh rupees. Gland Pharma and Mankind Pharma soar over 3% as brokerages bet big on both stocks. Reliance gains 1% after Bernstein says that clean energy will represent a new growth pillar for the company. Hero Motor perks up on an aggressive launch plan announced in its investor meet. Tata Chemicals gains after competitor Nirma cuts soda ash prices. Inox Wind tumbles on merger with its parent company. All right, well, those were all of the top stories. On to the first headline now. The market gained for the second straight day with the Nifty and the Sensex ending over 0.5% in the green. The Midcap index hit a record high after it soared over 1%. However, financials continue to underperform. The blue chip Nifty Bank ended 0.25% higher. Meanwhile, India's market capitalization has risen further and is at a 7-month high of $3.52 trillion. Prashant Nair is here with the details.
Well, the handover was great, right? So you had US markets which looked pretty good. Nasdaq was up and up. You had the consumer price inflation numbers here, which kind of signaled to the market that maybe the RBI in August, when it meets, will turn a bit more dovish. And the market started strong. It built on gains, even from the opening level. I mean, the Nifty ending about 70, 80 points higher. So you made money by getting in mostly at any point during the day. Midcap index at a new all-time high. Small caps, of course, now 11th week of continuous gains. So I think, it's a space we've been highlighting, and gains have been amazing. I'll get to stocks there in just a bit, but in the Nifty, Tata Consumer, Cipla, Asian Paints and Titan were the top gainers. Now we get to the real deal, mid-caps and small caps. And again, the breadth of the move is just amazing. Electra, Tata Communication, Tanla Solutions, Trent, HBL Power. Some of these stocks, HBL, for example, is up 30% last week and is having a great week. And we're only in the second day of this new one. Bombay Burma, Loda, JBM Auto, again, has done very well this month. Nazara Tech, Oracle Financial Services, Devyani is creeping back to its previous highs. Kirloskar Ferrous, Ahluwalia Contractors, KDDL, and so on and so forth. Long list of volume-led gainers, and we've been highlighting this every day. Losses coming through in a few names. Indigo was down. KPIT cracked in the last 40 minutes of trade. HCC, Data Patterns, and Nucleus Software has been a big winner. Saw some pullback, some profit taking. Will the Nifty break out of this congestion zone? Will the Bank Nifty do the same? I think for that to happen, we need to get by the next 2 days, and those are important from a global standpoint. We get US CPI data today, which will decide what the Fed does tomorrow night. And of course, we react to all of it on Thursday morning. Back to you.
Okay, all right, Prashant. Thanks very much for that. Well, in market opinion, Vetri Subramaniam of UTI Asset Management believes that the macro environment has become slightly favorable for select companies. He also adds that pharma companies should focus on cash flows.
Capital is no longer as abundantly available for anybody to burn. So it's a question of who's able to stabilize their business model faster, prevent the cash burn. And suddenly, for the first time in maybe 6-7 years, there is a constraint which has come upon companies that they can no longer expect capital to be abundantly available and postpone profitability way into the future. So I actually do think for some of these companies, the environment has become slightly more favorable. But, again, these are very early days. I think the business models are evolving. I think it's critical for India to pull off and sort of be part of this energy transformation that's likely to happen from carbon to renewable. We need to sort of make sure that we are at the forefront of that, and we don't create a new import dependency like we had during the carbon era. I've been wrong about pharma healthcare for a while. It's been a dog even through the last year, but that's an area where incrementally we still think the valuations are supportive. Most of our conversations with companies across a range of businesses suggest that companies are going back to the drawing board in terms of stabilizing the business model rather than sort of looking to make extravagant growth plans. And that's typically the kind of environment in which you can get a good margin of safety in terms of purchase and benefit as these companies start to focus on cash flow and ROC.
Okay, well, on to the second headline now. SEBI has barred Zee promoters Subhash Chandra and Puneet Goenka from holding any position in listed entities. This will pose another hurdle for the Zee-Sony merger, as Puneet Goenka was supposed to be at the helm of the combined entity. Zee promoters have moved the Securities Appellate Tribunal against the order. Surbhi is here with the details.
There is a fresh setback for the Zee-Sony merger as SEBI bars Subhash Chandra and Puneet Goenka from holding any key managerial positions in any of the listed companies. Now, this is a major setback as Puneet Goenka is slated to be the CEO of the merged company. Now, what has happened has SEBI has found that SL promoters have siphoned off funds from Zee for their own benefits. And now, Subhash Chandra and Puneet Goenka are allowed 21 days to file their reply to this SEBI order. SEBI has highlighted multiple instances of poor corporate governance issues. They traced multiple transactions showing misuse of resources to pay off promoter dues. The first one being where Subhash Chandra provided a letter of comfort to Yes Bank for a 200 crore rupee loan to SL Group Mobility. This letter assured a fixed deposit of 200 crore from a group entity including Zee. On the basis of this, Yes Bank adjusted the 200 crore rupee FD of Zee against any such dues. But a large part of these funds originated from Zee itself or any other listed companies. Now let's look at a flowchart of one such circular transaction. Now Zee gave close to 8 crore rupees to Living Entertainment, which then moved to Khoobsurat Infra, which then moved to Spirit Infra Power. Similarly, another 9 crores moved from Zee Entertainment to SL Business Excellence to Spirit Infra Power. Now, a total of 17 crores has moved from Spirit Infra Power to Pan India Infra to SL Green Mobility back to Zee Entertainment. It can be seen that the Zee money received from the SL Group company had originated from the bank accounts of Zee itself. In another instance, SEBI flagged fund siphoning in SL Group's Shirpur Gold Refinery, where Shirpur Gold Refinery promoter group company diverted assets worth 400 crore rupees from 2019 to 2021. Based on this, exchanges BSE and NSE were asked to review their consent to the Zee-Sony merger. Now, what's next for Zee? The company is reviewing the order, and CNBC-TV18 learns from sources that Subhash Chandra and Puneet Goenka have moved to SAT against the SEBI order, and the plea will be heard on June 15th. And finally, NCLT hearing is on June 16th, which will take note of all these latest developments.
Okay, all right, Surbhi, thanks very much for that. In fact, we did speak to a few experts to understand what this development could mean for Zee Entertainment. Listen in.
First step would be to get Puneet Goenka's name cleared of all the charges which have been levied against him. And that itself will take, I think, a few months before anything goes further. So that will be the first step. And then, of course, the other issues will have to be sorted out. Each forum will have to find a solution to whatever is pending before them, come to a decision. And therefore, you are right, it's totally a tangled bit of business. It will take months, if not years, for this to be settled.
The question remains is should Puneet Goenka be paid the non-compete fees of 1,100 crores, given that he will no longer not even be in the merged entity? The other way of looking at it from Puneet Goenka's point of view is that if he's no longer going to be the CEO of the merged entity, is there any case for them to have that merger? And can he just continue running Zee at a 4% equity shareholding? That again remains to be concerned. The question remains is, will the Goenka family or Subhash Chandra want to be on the other side of the merger, given what has happened? But by and large, I think at this stage, it will simply be that Puneet Goenka and Subhash Chandra will fight this SEBI order to the extent that they can.
I don't think Sony is going to back out because I think Sony is also wanting to do the merger just as Zee has been doing. So we have seen positive commentary also. Like, if you look at Sony counterpart back in Japan, they had raised a statement that they expect the merger closure to happen in the second half of this financial year. So clearly trends are moving towards the positive side in terms of wherein Sony does not want to back out. One more reason to note here is that Sony is already aware of these developments. So whatever has been happening in terms of the reasons, in terms of why they were asked to reassess by the exchanges, whatever has been given off in terms of money siphoning or the other allegations put, on the promoter group, Sony is very much aware of these things.
Okay, well, moving on to another headline now. Tyre manufacturing giant MRF has created a new milestone for the Indian stock market. The company's stock has become the first to cross the 1 lakh rupee mark. It has taken the stock more than a decade to climb from levels of around 10,000 rupees per share to 1 lakh rupees. Hormuz Fatakia joins in with the details.
Well, it is a momentous day if you are an MRF shareholder, as the tyre manufacturer became the first Indian company to cross the mark of 1 lakh rupees a share. Now, the company had first entered the 5-digit club in February 2012 when it closed above the mark of 10,000 rupees. Since then, the stock has gained 900%. Now, while MRF at 1 lakh rupees would make for a good headline, when you compare that to its peers, MRF turns out to be an underperformer. Now, had you invested in shares like JK Tyre, Balkrishna Industries or CEAT, investors would have fetched a lot more money when you compare returns from February of 2012. Now, it may not come as a surprise to many, but most of the analysts who track MRF have a sell recommendation on the stock, and all of them are citing expensive valuations behind their bearish stance. Now, the two of them who are not bearish have a hold rating and an accumulate rating. In fact, Elara Capital in its note has said that MRF's diversified businesses make it less vulnerable to a slowdown in any particular segment. Elara has a price target of 1,01,525 rupees on MRF. So despite the surge that MRF has seen over the last decade, it is still an underperformer if you compare that to its peers. Nonetheless, if you still wish to buy an MRF share, be prepared to shell out 1 lakh rupees for the same.
Okay, all right, Hormuz, thanks very much for that. Time for a short break, but we'll be back with all of the other top stories. Stay tuned. Welcome back. You're still tuned into markets today on CNBC-TV18. Well, the fourth headline in the pharma space, Mankind Pharma and Gland Pharma surged in trade after a strong brokerage commentary coming in from the likes of JP Morgan as well as Bernstein. So I'll start with Mankind, where JP Morgan initiated coverage with an overweight rating and a target price of 17.30. According to them, this is, the company is one of the fastest growing domestic pharma companies, has consistently outperformed the industry, and they believe that market share drivers include a strong product portfolio, large distribution network, ability to build brands as well. For Gland Pharma, Bernstein has an outperform and a target price of around 1,702 rupees. According to them, for most of the top 10 molecules, they see partners' market share recovering from what was a trough. They have written about specific molecules such as daptomycin, which is basically an antibiotic, micafungin, which is an injection, an antifungal injection, enoxaparin, which is used for blood clotting. All of them have improved in terms of market share in recent months. Vancomycin's market share has been declining slightly, which is an antibiotic, and heparin, which is an anti-blood clotting injection, has seems to have stabilized when it comes to market share, and it will depend on the supply issue resolution as well. So overall, positive in terms of the stabilization or increase in the top 10 molecules that Gland has, according to Bernstein. Well, in more brokerage views then, Reliance Industries gained over 1% after brokerage firm Bernstein put out an outperform rating on the stock. It highlighted that clean energy will represent new growth pillars for Reliance going forward. Sonal is here with the details.
Well, yes, clean energy is the one that they're focusing on, and they have ascribed a value to this particular business as well. They talk about it being the next growth engine for Reliance Industries and has a lot of sectors, be it solar, battery, electrolyzers and fuel cells as well. They say by 2050, the total addressable market consisting of all these segments would be around $200 billion, and investments in this space in India itself would be to the tune of $2 trillion. Clean energy business will be around 200 rupees per share today, according to Reliance, according to Bernstein, and it has a scope of expansion from these levels as well. Reliance Industries could achieve a revenue of around $10 billion. This is by 2030 in the new energy business, which is around 40% of the total addressable market. They could capture 60% of the solar market, 30% of the battery market and 20% of the hydrogen market as per the Bernstein report. This is about the green energy and the new energy business that Bernstein has spoken about. Even their traditional business, Alto Chemicals, is doing really well. They say it will benefit from low-cost Russian crude feedstock, which will lead to an O2C EBITDA in FY24 to the tune of 63,000 crores, which is a 1% increase on a YOY basis. What is working for Reliance Industries here is that Russian crude is at a 20 to 25% discounted Dubai oil price, and this would mean that their realizations or spreads would increase by $6 to $8 per barrel. Now that is a big increase that they're expecting here, and additionally funding is not an issue for Reliance Industries. That's because their current balance sheet and free cash flow outlook is very strong. They have an outperform rating with a target price of 3,040 rupees a share.
Okay, all right, Sonal. Thanks very much for that. On to the fifth headline today. Tata Chemicals is in focus as its competitor Nirma has cut soda ash prices by around 2,000 rupees per metric ton. Brokerage firm Centrum believes that nearly 6% price cut will impact the operating profit for the domestic soda ash companies. Sonal is still with us to give us more perspective on this.
Well, Tata Chemicals is in focus because its unlisted competitor, that's Nirma, they have gone ahead and cut soda ash prices, and it has been cut by 6%. So that's a massive cut that's coming in, and this would be the third price cut that the industry overall has taken from April itself. That's Q1 of FY24. Remember, the first cut was in April 17, and there has been a cut of around 1,200 rupees per ton so far in the entire industry. That's at a national level in Q1 itself. Now, what does it do for listed players like Tata Chemicals and Soda Ash? They haven't taken the third price cut yet. They've cut prices twice so far in Q1. But Centrum says this sudden price reduction by Nirma would instigate other players to follow suit as well. So they expect these companies to go ahead and cut prices. Coal prices are coming off, of course, which is beneficial for these companies, and they're passing it on to their customers as well. But 6% is surprising, and which was not expected, and it could impact EBITDA per ton for all these companies and for the domestic caustic soda ash players in the current quarter. They believe Tata Chemicals and GHCL are also going to go ahead and take these price cuts as well, and this will be negative for Tata Chemicals' domestic soda ash business and also for GHCL. So these two stocks will be in focus.
Okay, all right, Sonal, thanks very much. Well, let's move on then. Hero Moto gained on the back of the company's commentary in its Investor Day meet. The car maker has plans to launch 4 new cars in its premium segment. It is also looking at expanding its premium outlets. Sonia's here with more details.
Oh, absolutely. You know, the stock has been under a bit of pressure since morning, down about 0.3% for a couple of reasons. First, of course, there was an Investor Day meeting which was held where the company spoke about aggressive plans in the premium segment. Now, they're looking to have to line up 4 new launches in the premium segment, and they're looking at setting up 100 plus exclusive premium outlets. They currently have less than 5% share in the premium end of the market, and they're looking to ramp that up. The other focus area for Hero MotoCorp is a ramp up in the electric vehicle segment, and they highlighted that at the Investor Day as well. They spoke about how they plan to launch EVs in 100 plus cities by FY24. They plan to launch 2 new scooters in the mid and mass EV segments by FY24 as well. So it's a 3-pronged strategy that Hero Moto will have going forward. One is expanding the core segment. Second is growing the premium end of the market, which hasn't really worked well for them. And the third is expanding the electric vehicle segment. Now, the reason why the stock is under pressure today is because CLSA has come out and downgraded the stock to a sell. They have retained their target price at 2708, which is well below the current market price. And they say although the plan that Hero MotoCorp has is quite aggressive, there is a lot of competitive intensity in the two-wheeler market at the moment, and growing their market share from current levels will be a bit challenging. Also, the stock has run up a fair amount in the last couple of months and perhaps has priced in a lot of the good news. So on the back of the CLSA downgrade, the stock is underperforming the market and under a bit of pressure right now.
Okay, all right, Sonia, thanks very much for that. Well, in some more stock-specific news, Inox Wind tumbled over 3%. This is after the board has approved a merger with its parent company, Inox Wind Energy. Vivek Iyer is here to break down the details for us.
Well, you're absolutely right. It's actually all part of the group's plan to go ahead and now simplify, the quite complex structure that they had. So earlier, they used to have 3 listed entities. Now, after yesterday's move, you'll have 2 listed entities as far as the renewable energy business is concerned. So what's actually happened? Inox Wind will now be merged with its parents, that is Inox Wind Energy, and the merger will be done with itself. Now, as of yesterday's close, the merger ratio was slightly in favor of Inox Wind Energy, which is what explains, the stark divergence as far as, the outperformance of Inox Wind Energy is concerned versus the underperformance today of Inox Wind is concerned. So now 158 shares of Inox Wind would be issued for 10 shares of Inox Wind Energy, and 158 share warrants at an issue price of 54 will be issued for 10 share warrants of Inox Wind Energy at an issue price of 847. So what is the rationale behind the group? The company says that, it simplifies and streamlines the group structure. Also, it ensures consolidation of the wind energy business operations into one single entity, and they believe that this consolidation should lead to greater efficiencies.
Okay, all right, Vivek, thanks very much for that. Well, now on to a CNBC exclusive. GQG Partners remains bullish on the Adani Group. The company chairman Rajiv Jain says he will buy more stake in the conglomerate over time. The fund even increased their original investment in Adani Group by 10%.
We don't have any target or anything. It depends on how the fundamentals evolve. But yes, I've already said that we are interested in increasing our stake over time. We do feel, in fact, the numbers subsequent to a purchase, as the earnings numbers come through, they've been fantastic across the board. It hasn't gotten as much press, but the numbers have been from ports to enterprises across the board, massive beats. So yeah, we quite like how well they're positioned on a longer term basis. So yeah, we are likely to add, but it'll be. We don't have specific targets, dollar targets, because it depends on so many things.
Okay, and let's shift focus to the economy now. Retail inflation, CPI, cooled to a 25-month low of 4.25% in the month of May as food prices eased. Inflation has remained within the Reserve Bank's tolerance band for the 3rd consecutive month. Meanwhile, India's industrial output picked up for the month of April. Lata Venkatesh is here with the details.
Well, it's always a double delight, isn't it? Growth higher than expected, inflation lower than expected. What more can we ask? But my thesis is that in this specific instance, the growth number is more important. Technically, CPI is more important because the interest rate is set on that number, and that number has come in at 4.25. Remember, the Reserve Bank has a mandate to bring inflation down to 4%. So this at 4.25 compared to our poll and compared to the March number of 4.7 is very good. It's a 25-month low that the inflation has come in at, and the constituents are also extremely encouraging. Food inflation coming in at 2.91 compared to 3.84. Core inflation, which again, it's base supported, but it's come in lower, 5.1 compared to 5.2 in March. So all ends up, it's a great inflation number. But I do want to emphasize that the Reserve Bank is usually privy to this number. I mean, they have a very decent nowcast of the data. And so on June 8th, they would have been aware that the May inflation is not going to be a nasty shock. They would have known it's 4.3. So the market should not read this as an indication that it may soften its stand in August. The Reserve Bank's message very clearly on June 8th was, we are not in the mood for cuts. They just want to see a sustained 4% before they move in favor of cuts, and therefore one shouldn't read this data beyond what it is, a good number. But growth is a very positive number because in April industrial output at 4.2% was against a market estimate of 1.3. And the constituents are very encouraging, 4.9 on manufacturing. Within manufacturing, metals, non-metallic items, machinery and transport equipment, all of them have shown nearly double-digit or over double-digit growth. So this is actually a very good number. Outside of manufacturing, the use-based classification, infrastructure has grown by about 6 or 7%. Capital goods has grown 6.2%. Okay, infrastructure 12.8%, consumer non-durables 10.7%. All ends up a great growth number coming on top of a Jan-March GDP, which surprised on the upside by 1 full percentage point. Now, the April industrial growth also surprises on the positive. I think this is a great growth story. This double macro data is positive stocks, not positive bonds. And I think the market's reflecting that.
Okay, all right, Lata. Thanks very much for that. And with that, it's a wrap on this edition of Markets Today. Thanks very much for watching.